my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets. Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis, or on any related items on these my charts. This is all my own original work, as I think you deserve to have that. So with that, New York coffee. This market right now continues to be the story of just about two bearish pitchforks. The first bearish pitchfork is the dark blue breached thrice and repaired, possibly thrice, early February to early March bearish shift pitchfork. We are right now playing once more either side of the dark blue lower time, which is currently at 285.40. We're also well within a large stratified series of support starting at 290.85 and stretching down to at most 252.25. The second pitchfork is the more recent and larger bright red early February to late April bearish Andrews pitchfork. On this one, the market is right now just above the declining middle time, currently also at 280.65. We also have below, as I said 5 weeks ago, and I quote, "We might have a possible whole of 2025 a very large double top pattern." Now this hasn't happened as yet, but it is worth considering and especially remembering. Thus, whilst they are not targets yet, we might have a primary potential down in the 263 even zone and a secondary harder to reach potential down in the 229 zone. End of quote. 7 weeks ago, prices pushed down below the key 325 to 320 support zone. Then down through the next support zone below between 309.90 to 310.80, made up from the May 2011 high at 309.90 and the 50% Fibonacci line, the May 24 to February 25 move at 310.80. And, as I said 6 weeks ago, and I quote, "This now formalizes the targets below of a primary target X down at 263 even and a secondary harder to reach, seemingly much harder to reach target X1 down at 229. End of quote. We've seen prices trying to push lower with decreasing highs and fairly flat lows, usually seen as a market under bearish pressure, down through a small congestion zone between 301.50 to 303.40, as well as the rising neckline, which is currently at 308.25. Then down below the neckline of the small August to October 2024 head and shoulders continuation pattern, and to a whole load of congestion, principally holding up at the June 2011 high at 276.75. This is, as I discussed 6 weeks ago when talking about the stratified supports below, when I said, and I quote, "The beginning of various stratified supports from the September 2011 high at 290.90, quite widely spaced I have to say, until the congestion at 252.20. It is these stratified supports that we keep testing down towards. At the moment, it seems we may take our time heading lower, but we seem intent on doing so. So please remember those targets below." Now, there is something else I'd like to look at here, and for this I am indebted to Ray Bradbury for asking me about New York coffee some 21 weeks ago. And I went at the time to my longer term charts, the monthly charts, where we can see some possible insights. You see, on the monthly longer term charts, I noticed a pattern that had not been immediately obvious to me at the start of 2025, when I last reviewed the longer term charts. It is a multi-year 2012 to 2024 very large reverse head and shoulders bottom, a bright red neckline on my chart, currently at 275.60. The break higher over this neckline reached its primary target on the upside, but there was a secondary, harder to reach, much harder to reach target X up in the 433.35 area. What was interesting about this secondary target is that nearby is the next 100% projected Fibonacci line here at 433.75, quite close in the scheme of things. Now prices did indeed turn lower at this key combination of the 100% projected Fibonacci line and target X at 433.35, dropping down through and closing below the important 50% projected Fibonacci line at 347.20. Thus, prices for the first time in May this year closed back down below the dark blue upper time, currently at 285.65, of the interesting 2019 to 2023 bullish Andrews pitchfork. Since then, we have dropped down further, below the dark blue middle time, currently at 309.95, and in July prices dropped down to the bright red neckline, currently at 275.60. In July, the market rejected pressing further lower though, through the bright red neckline, and so far in August we have seen the same action. This is a key neckline and one that will decide the future of this market for many months, if not years. I continue to monitor the market's longer term reaction to this bright red neckline below. London coffee. Towards the end of May, the market breached and then broke down through what was a large, shallow bull channel. Prices carried on lower, and I said of this bearish pressure 14 weeks ago, and I quote, "They now have the overhang of the market from roughly 5,300 up to this year's high at 58.49 sitting above." This overhang of bearish pressure and ammunition is important as it started to press lower, heightening the impactful force of the break below the shallow large bull channel. Thus, for such a break low, we had a primary target down in the 41.64 zone, reached 8 Fridays ago, and a secondary harder to reach target down in the 35.15 zone, reached 6 weeks ago, plus a tertiary, much harder to reach target X2 down in the 28.60 zone, which is still live. So what do we have in the way? Well, I recently drew a bright green mid-February to late May bearish Andrews pitchfork. We did have the bright green lower time available as support for a while, currently at 32.41, but we have been challenging below and then back over, only to push below it again since late June. It was as I said 2 weeks ago, and I quote, "In truth, I suspect it's now acting more as an attractor rather than a declining support." We now have overhead a pair of interesting 50% Fibonacci lines for November 21 to November 25 move at 38.08 and the May 21 to February 25 move at 36.49. That's the end of the quote. 6 weeks ago, when looking at the market action, I said, and I quote, "We have some congestion at 35.53, but I think a move down may be on the cards." Then we have a fairly free zone below, down to the combination of the January 24 high and the May 24 low, both in the 32.59 to 32.61 zone. End of quote. This zone, between 32.59 to 32.61, halted for a while. The market then slowed the attempts seen to try even lower, such that prices have shied away from testing the next support below that for now, which is at the lesser Fibonacci line at 31.29. Though they have been making lower highs in the meantime, a typical bearish build-up sign. So, with that in mind, what have we below that might slow the move? Well, to be honest, not much. Apart from the Fibonacci line at 31.29, we seemingly only have congestion at 30.11 dating from February 2024, along with the February 2024 low at 29.81. So, not much. It'll be interesting to see how any bearish pressure emerges this week and going forward. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.